Hello everyone, we are waiting for our speaker to join. Please wait for 5 minutes.
you have any doubts, you can raise your hand. I'll enable the microphone.
Good afternoon, everyone. Our guest hasn't been able to join us yet. We're sorting that out. But by then, let us quickly introduce what is VC Bootcamp. So, the entrepreneurship world has risen to limelight in the recent years, and along with it has grown the uncertainty regarding the investment landscape. Today, it stands as one of the most impactful and leading sectors to go to for top professionals as they look to build their career and create a meaningful impact. The Venture Capital Bootcamp is organized by ECEL IIT BHU, and it aims to nurture a community of venture capital enthusiasts and support the growth of innovative startups. In this bootcamp, you have the opportunity to learn about the investment landscape from scratch, interact with the partners of leading VC firms through regular Q&A, complete thoughtful assignments to understand the venture capital ecosystem, and also to grab the official certificate from ECEL IIT BHU along with the associated VC firms. On completion of this bootcamp, you'll also be qualified for an internship opportunity at one of the VC firms. Hello, sir.
Hi everyone, am I audible?
Yes, sir, you're audible.
Hey, sorry, I was just unable to join before, but thank you all for waiting, and delighted to be here.
Sir, I'll quickly introduce you. We are pleased to have with us Mr. Shashank Randev, the founder of 100X Capital. He has 15 plus years of diverse experience spanning large corporations, founding a SaaS startup, which was Fortune 500 company, and an early stage fund investment in tech startups. He is an angel investor and advisor with a passion for B2B emerging tech startups, particularly in fintech, health tech, SaaS, deep tech, and clean tech. His background includes pivotal roles at VCC Edge and leading initiatives at NIIT Limited and Genser Technologies. Shashank Randev holds a bachelor's in engineering from Nagpur University and an MBA from IMI New Delhi. Shashank, sir, over to you.
Thank you. Just checking again. I hope I'm audible, clear.
Yes, sir, you're audible.
Okay, great. I'm just trying to share my presentation. Okay, I hope the screen's available and visible.
Yes, sir. So the screen is visible.
Okay, great. So without further delay, thank you all for taking out the time. And my sincere apologies for being late. Was not able to connect due to bad network at my end. I hope the network maintains itself over the course of the 1 hour. I like this to be a very, very interactive session. So what I'll do is I'll spend like 20-30 minutes going through a presentation, followed by any questions you might have on the slide. We can keep going to and fro on the slide as well. And then we'll open it up for specific Q&A. Just give me a moment. Okay, so my name is Shashank Randev. I'm the founder VC at 100X.VC. We are an early stage fund. We have a fairly large portfolio. We've invested in 142 companies over the last 4 years. And, we are essentially the first institutional check in our portfolio companies We want to invest in very high growth companies, and at least 25% of our portfolio companies come from student founders who freshly passed out of colleges, engineering colleges, and MBA colleges. Quick stats: we invest in cohorts of classes, and as I said, 140 plus companies, and we invest as a first check, and then we announce them at the VC pitch day after 120 days, where we've seen 75% of the founders get funded through VC funds, growth stage VC funds, and 25% being angels and HNIs. And they've managed to cumulatively raise 72 to 75 million USD post our funding, out of which 10% have gone to Series A. So while we are investing and we come in very, very early, we've evaluated more than 26,000 companies over the last 4 years. And in fact, I think it's now close to 35,000, right? And there are things and patterns which we see, which are intentional by founders and sometimes not intentional. And the objective over here is to give you a sense of how VCs perceive business ideas when startup founders are pitching, either in euphoria, enthusiasm, but sometimes missing the business sense. And I'd like to touch upon those points today. So I think one of the first reasons why founders don't get funded, irrespective of whether second-time founders or first-time founders, is their inability to communicate their idea. They fail to develop a convincing pitch narrative that will attract or persuade the investors to fund the idea, right? Their pitch is largely on technology product, but not as a business, right? So, it's key to remember that a complex idea, though very useful, has absolutely no value to customers or investors if they can't understand it. Then, I think everything can be built, but it's not necessary to build everything. I think the biggest failure happens when tech founders or founders are unable to release the product as they're building it ground up. They end up doing a lot of things together. Case in point, Amazon today. It's taken them 30 years, but they kept their focus in the initial days in one vertical domain, which is e-commerce of book selling. And I think that vertical concentration is what drives focus, and this is what seed investors are looking for. I think another reason why founders don't end up succeeding is because startup founders end up hiring people for their track record and not their potential. They're afraid to do sales by themselves. They very early on they hire experienced people who don't fit the culture. They come with baggage, entitlement, commitment, expectations, and way of doing things at work are quite different from what the culture is there at the prevalent startup. And that's one of the reasons why founders kind of have initial tension, which stunts their growth. Being successful in raising too much money, I think we've seen this time and again that too much money is like having too much time. So founders lose the focus. They end up building a plan to spend, but not to build a business, right? And too much capital at seed stage changes the team mindset in unhelpful ways. So always remember, shortage of capital in early stage forces a startup to make hard choices about what they build and what they want, what they won't be building. And I think it's very, very essential to understand. I've talked about this. You can go onto my LinkedIn. In one of my recent posts, I talked about one is a concept called product market fit, and the other is founders market fit. Right? We all talk about 0 to 1 journey, but there's another journey called -1 to 0, which is essentially your ability to kind of behave like through the chaos and decide that this is one area of the market you want to focus on. And I think that product market fit comes in later, and founders market fit is the most crucial to begin the startup journey. But again, you're building a business and end up building, even if you believe that there's a market, right? You'll end up building a product which no one wants, and that doesn't really help anybody, right? So all founders have a hypothesis that they are solving for a big problem, and they go all guns blazing just on initial evidence found on anecdotal success, right? And it puts you on a wrong track because you've not mapped out your total addressable opportunity. It's very, very important that you have a horizon, you have a clarity on the product you've built, and you've identified your customer, user, buyer, your client for the next 5-6 years, right? because if you build a product that solves no one's problem, then obviously there's nothing tangible or scalable to build here. We've often seen that, with the whole advent of startups getting funded, people reading about the funding scenario, I think people forget that, we are Indians at the end of the day, and frugality is in our blood. But we end up spending a lot on reckless partying, office space, customer acquisition, promotions, advertising, and initial days is really about planning and executing and being very, very frugal, because if you've raised money, you're accountable. You're running on a treadmill. You need to answer to your investors, and it's your fiduciary job. I think that mindset is something which investors check for. Now, this is an interesting one which I see a lot. Getting a large contract with a big customer early, right? A lot of founders, they build a great product, teams are full time, they're working hard, and then they get this one client which is essentially giving them 1 lakh rupees, hypothetically, right? And they let go of 10 customers who are willing to give them 5,000 rupees, right? Now, in my opinion, I think it's very important not to get a customer just for the price point, but your ability to kind of push your products or service in multiple avenues, right? Or having multiple clients, irrespective of what revenue they're doing, because that is a step towards product market fit. Because if you don't achieve product market fit, your revenues will never come. But if you just start focusing on revenue, just that one customer, you will never realize or understand the product market fit to that one big customer. And it equally creates financial dependency. We've also seen Superman founders become bottlenecks for growth, right? Some of the founders are lone rangers. They think they can't work with a team. They don't trust anyone. They don't delegate. Reach a point where they'll have fatigue in decision making, right? And that's why to build a large scalable business, you need to have a team. You need to have a co-founding team. A lot of people tell us that Steve Jobs built the company by himself. No, he wasn't. He was the face of the company, right? There was Steve Wozniak. There were other chief commanding officers who were helping him build, right? The first team of set of 10 people who were not known, but he couldn't have done it without them, right? So there are many such cases and case studies which you can refer back to, but no single founder can essentially build. Even Elon Musk could not have built 2 companies, while it required his leadership, but he had a team, right? So learn to delegate so that you don't reach a fatigue in your decision making. Raising money from wrong investors with no reputation, I think founders get too excited at times. Your selection of the first lead investor is a critical decision, which should be taken on an investor pedigree and not based on investment amount, right? These investors help you establish your product market fit, maybe possibly make introductions to the first set of customers, right? Very, very important to understand the role of the first investor who comes on board, who's just not coming in for the money, but essentially opening up his network, her network. Then founders looking to generate income and not wealth, right? The first and only priority should be about the financial health of your startup, right? Salaries are important, right? But if you're raising funding and you wanting to take 25% of that for salaries, it doesn't work like that, because you're raising money to find product market fit. Your energy should be focused on that, because founders anyways own a large share of equity percentage, right? So your idea is to increase the value of that equity, and therefore focus on wealth creation. Again, I've touched upon this. If you're building everything, therefore you'll end up landing in too many revenue models and multiple directions, and everyone seems to be your customer. That's another problem, right? So each stage startups are trying to ape large corporate businesses, which happens a lot, right? And everything cannot scale at the same pace, and if you're not scaling at the same pace, you won't get funded, right? So hence focus on that one model, master that, become a category leader in that. Otherwise you'll end up becoming a bespoke services business, or a living dead startup, as we call it, and nobody's interested in funding those kind of businesses. Again, frugality, I've touched upon this, but a lot of founders end up spending a lot of time buying technology, but in the initial days, you need to kind of validate your product and focus on growth hacks. And there are many such examples nowadays in 2023. There are successful founders who build businesses by using growth hacks and not spending too much. And you should understand what are those methodologies. Again, these are issues which can be overcome eventually, but they persist. You don't want to step into a place where you're building just another business which can be copied, or there's no market differentiation. Because VCs are in the business of investing in disruptive business, right? The brightest idea will fail if there is no plan to make money, right? The so-called cool, unique, and noble idea out to change the world cannot survive by having perpetual losses, right? So there has to be a path, a visible path to profitability. As I said, startups, VCs want to invest in, high growth, innovative businesses. So there is no moat, unique IP, or barriers to entry in your business, then you will not get funded. And again, we've invested in a Kerala banana chips company called the Kerala banana chips, right? And a lot of people ask, what's the moat over there? The moat over there is execution. The moat is to keep hygiene and standardize, introduce processes to standardize the taste of the chips and the packaging, and that creating a category in the segments of Lay's and other chips brand, where Kerala banana chips has largely been sold in plastic bags since my grandmother days, right? So the execution matters a lot, right? And by the time we were investing in this company, they were already doing 2 lakh rupees per month. So there was a stickiness of the product, right? So IP is not the only thing which gets you. You could be building a very novel business, but your first mover's advantage or second mover's advantage, but your execution and stickiness of the product, I think, determines if you will get funded or not. Not careful with their equity allocation. I think we've seen this a lot, where founders just end up giving a lot of equity and then they dilute their company a lot, right? And that puts a lot of pressure on the founders to keep performing, and they still require money, right? So compensation by equity is the costliest way of financing your business. So be very careful when you start doing that. So to sum it up, why certain startups don't get funded. Companies that can grow fast and absorb capital at a high speed do not fit into the investment thesis of a VC. Asset-heavy businesses don't attract VC funding. VCs like to invest in asset-light business models, which bring in technology, innovation, and team execution. Lack of focus, too many moving parts, or absent complementary skill sets of the founders. Basic unit economics, no clarity on financial metrics. Capital structure, too much dilution. So like everything else, I come back to the first point, communication. Like anything else, practice makes perfect. Remember, how you say it is just as important as what you say. So if you can't summarize your business in 2 lines in 30 seconds, right? That's a problem. So once you cross that barrier, there are certain things which you always need to have and be on top of, right? When you're compiling a pitch deck. One is team slide, your complementary skill sets, the problem statement, how big is the TAM, solution, product brief, USP impact, talk about the expected business impact, the key USP, market opportunity, I've already said that. Comparative analysis, this gets me going because it helps me understand what is your moat, your differentiation, positioning, how your positioning is different. Journey so far, where have you reached, what's the product growth, business roadmap, product roadmap. And then again, know which metrics are applicable to you, right? Could be customer acquisition cost, number of logins, if it's a SaaS business, retention, TAM, burn rate, net churn, and one size does not fit all, right? So you need to take a deeper dive into what you're building. You might be a tech individual, but if you're building a business, then you need to get yourself familiarized with business aspects, with profitability, with margins, and the metrics which matter to your business, whether it's brand, whether it's a SaaS business or even a deep tech business. Therefore, convert your product to a business, right? If you are only going to talk about your product and the investors don't get a sense of business, they won't fund you. Because every time you talk about unmet need, market size, solution, team execution, financial projections, terms of investments, exit, what VCs actually hear Is there money to be made? Are these the people who can make me money? And how much money can I make? With that in mind, our investment thesis is very clear. When we are investing in companies, founders, we're looking at the founding team, their complementary skill sets, the total market size opportunity, the business model strength, their unfair advantage mode, and our conviction of a minimum 20x returns, our ability to kind of create more value through our network. We have a standard check size of 1.25 crores. We've funded 142 companies. If you're building something exciting, feel free to upload your information on 100x.vc/class11. We have a response time of 7 days and happy to kind of schedule a call and deep dive into what you're building. We invest only through iSafe, which is India's simple agreement for future equity, which means that you don't have to value your company today. Raise the money, take the money from us, let's build the company together, and then assign a value for the next funding round. This enables founders in deep tech, in IoT, or in any industry, D2C, to kind of get started. And I think it's very, very important. It's a very friendly document. We've made it open source for our founders to go onto the website, look at the iSafe page, and download documents, even if they don't end up raising money from us. The features are highlighted, again, very, very simple to use. I won't get into the specifics. Some of the VCs who've invested in our portfolio companies after we've funded them, and almost everyone's invested in our portfolio company. We also run an analyst trainee program. So we've trained 40 plus analysts, which have gone through the 6-month trainee program, and they've all gotten placed in other VC funds. It's an in-person in Bombay 6-month full-time trainee in Bombay. And if you guys are looking for some level of internship, which is bare minimum 6 months, so feel free to apply through the link. Some of the interns who've gone through us, Arvind, he was an intern. He's now running Imperia Group. Bhairavi, she's the investment associate now at Rockset Capital. Dravya Dolokia has started his own ventures, Dravya Dolokia Family Ventures, right? And so many others have gone through the entire. And you can look at all the profiles through that website link, which I've shared. We also run a non-for-profit 100x Gurukul initiative, which essentially is for founders who, think they're not ready to apply for funding, but still need to learn. And this is a free 12 weeks online course about product development, how to sell to enterprises, what not to do, what to do while you're hiring, so on and so forth. Again, this is an article you should all read. It's in Forbes India, 0 to 1 and beyond, essentially talking about our journey, and essentially talking about how we provide a combination of smart capital, which is capital, education, and network. We again do a lot of walk-in pitches. My apologies, this one is an old one. We are having a walk-in pitch tomorrow in Bangalore, where we invite 100 first-come, first-basis startups who come in, pitch to us, and if you like the ones, we shortlist them and then directly fast forward to moving to issuing a 1.25 crore check after they've cleared the DD. So with that, I come to an end. Again, I'll be very excited to kind of take up questions and make this more interactive. So over to you guys now. Hello. Just give me a moment, guys. Yes. So questions. Hello.
So we have a question. What's founder market fit? And the next question is, you said that product doesn't have to be perfect and has to reach MVP fast, but don't we have to make it better than the competitor's product before launching it? Otherwise, what is our advantage?
Sure. So let me answer the first question. Founders market fit. What does that mean? So as I said, right, your mindset to have the ability to build a company, right? A product market fit requires a founder's market fit. To go to 0 to 1, you need to go first, have to go to -1 to 0. This is when you figure out what you want to work on. In my experience, motivation, drive, talent aren't enough. If anything, talent can make finding ideas feel more daunting because it increases the number of available opportunities. So your goal at -1 is to turn the chaos of everything you could do into conviction in what you will do. Right? Most people, especially first-time founders, underestimate this surge for conviction or fail to even consider it as a distinct part of their journey. Right? So what ultimately leads you out of the mess is conviction, a state you must build incrementally and internally before you find the product market fit. So that's the answer to the first question. The second question is, you said product doesn't have to be perfect. It has to reach the MVP fast. Yeah, because see what this means is that you can't keep waiting for the product to build out completely. If you don't start testing out the product with a few set of, that's where you've got versions, right? Beta version, alpha version, right? So beta version is essentially a test phase, right? So you need to have a pulse of the market, right? If you don't test it out, like tomorrow, if Kerala Banana Chips is launching a new packet, he just can't start producing, 1,000 packets. He needs to test out with a few samples to get the flavor tested, right? Whether it's working or not. Similarly, for a SaaS product, right? If you're building a collaborative tool, you need to kind of speak with a few employees of a large enterprise to understand their challenges, and then give them the product demo to understand, is it fine, are they finding any utility in that. A lot of founders don't do this, and they immediately go start building and then complete it, and then go out and only to realize that it's not only taking them time and money to build that, but it's useless, right? Or the changes which needs to be incorporated are even more expensive, right? So that's the point I was trying to make, that don't try and master or perfect your product without getting a sense of the customer. So that's the answer to the second question. The third question is, how much percentage of equity should be used as compensation in a good startup? Just give me a minute, guys. How much percentage of equity should be used as good compensation in a good startup? It really depends, right? I mean, if you're raising your first check, we have a check size of 1.25 crores for a future of 15% equity, right? But that's because we are the first institutional check. But we don't invest in companies who have already raised or diluted 5-6% in advisory equity, right? That just doesn't make sense. So, for advisors, it should not exceed beyond 2% in the initial days. And for your first institutional check, it can range between 15 to 20%. So I hope that answers the question.
So the next question is, what is moat?
See, moat is something which is unique to your business. Moat is something which gives you entry barrier, right? You're just like, if you come up to me, let's say John, I see Janvi on the screen. Janvi comes up to me and says that, I'm building an e-commerce portal which is doing the same thing as Flipkart and Amazon. I need funding. There is no moat here, right? Flipkart is already done. They've been funded. They have already audience, right? So it's as we call it, red ocean. Red ocean means it's already crowded. So your moat has to be something which is in the blue ocean, a problem which is becoming big and yet to be solved. So for instance, UPI is a great invention, right? Anything being built around UPI is a great enabler, right? If we've invested in a company which was doing, video editing and video dubbing through a software. Now that's a huge use case. Nobody else has been doing this, right? So that is what I mean by moat. Moat means that what is your unique USP, unique selling point, differentiator, because that is one thing which an investor will look at.
So the next question is, what should be the minimum requirements for an MVP to be qualified for an early stage funding or to attract investors?
I mean, think the minimum viable, product requirement is that you build a product, and you it's seeing utility, right? So if I can, so for instance, I give you an example of Vitra.ai, which can convert audio, any video into 52 languages. Now, when we invested in them, the MVP was that the product was working, right? I could input and output, and I could see the product working, right? If you've reached that stage and you have in terms of the market you're going after, that is the right time to pitch to an investor. Next question.
What is that one aspect you look in businesses that instantly convinces you to invest?
As I said, I already highlighted 5 points. One is founders team, founders complementary skill sets, their total addressable opportunity, the business model, and their moat, and how what is the disruptive thing they're building, and then our ability to kind of take them to a larger commercialization stage.
So the next question is, any tips that you would like to give to deep tech startup entrepreneurs who are in their final year currently?
Yeah, so deep tech companies is very interesting. We we've invested in at least 5 to 7 um, uh, deep tech companies, and in deep tech what happens is a lot of companies end up staying in R&D, research and development, right? Our objective is to take them from R&D stage to commercialization, right? But again, the same thing which I said earlier, is that for a deep tech company, if you're building a deep tech, that deep tech product should work in some capacity. We invested in a deep tech company which was using AI with a machine to do blood testing, right? So no commercialization, nothing, no, only one product which was in testing phase. We asked them, complete the one stage of the product where I can see the input and output. When you're saying you can give blood report in so many minutes, forget who's going to buy it and who's going to sell it. Let's see it work first, right? And I think that's my feedback for a deep tech entrepreneur who's building in final year. And again, feel free to apply on a website, right? Because no company gets rejected, because we'll say no to you today, but we'll evaluate you in 6 months' time. If you see progress, we'll go ahead and invest. We've done this many times with many founders.
Yes, sir. So we have our next question. What specific aspects of our business or industry attracted you to consider an investment?
Sorry, come again.
What specific aspects of our business or industry attracted you to consider an investment?
No, see, again, India is a very growing market, right? So fintech, deep tech, SaaS, all these industries are up for disruption, right? And therefore, we are very sector agnostic. And again, the question is same, right? Within a sector, when we're evaluating, we're looking at those 4 or 5 parameters: founders pedigree, total market, customer base, business model, and more. So these are common things which we look at.
Yes, sir. Sir, the next question, just a minute. Yeah, deep tech often requires a longer development timeline. How do VC firms approach and assess the longer term potential of deep tech investments?
I think deep tech is here to stay. I think we'll see a lot of innovation coming in deep tech, and we'll see a lot of folks coming in and disrupting and building out great businesses in deep technology, whether it's in healthcare, whether it's in industry IoT, industry 4.0. And I think you'll see an evolution of the next phase, in deep tech companies emerging right out of India.
Um, yeah. Hi, Shashank. Am I audible?
Yes.
Yeah, hi Shashank. This is Rohan. I'm a pre-final year student. Like you said, there's always a negotiation between, early stage VCs and startup founders regarding the fact that obviously VC want them to commercialize their product as soon as possible, and some deep tech startups remain like they want to ideally remain in their R&D stage for a while. So how does this negotiation stage move away further, because there's always a clash of interest, right? So how this usually goes ahead?
Yeah. See, again, I said, right, if you're unable to convert your deep technology into a business, you'll never get funded by a VC, right? The benefit you have is that today there are various stages of VC. There's a seed fund like us, then there's a growth stage fund, right? So growth stage fund will say, get me 10, 15 clients, right? But a seed fund like us will say, show me the product, and if you're able to connect you to 3, 4 customers, can you sell it to them, right? But at any given point of time, you have to get into the mode of selling, and it has to convert into a business. You can't keep doing R&D forever, right? And now your point could have been that, but my product will require some more amount of R&D, and I need money for that. I will commercialize this obviously at some point in time. Now for that, VCs don't come in at that point. Therefore, you have government grants like BIRAG, Atal Incubation Centers, Department of Science and Technology, which help you at that R&D stage. But if you are in that stage, and if you have a business model in your mind, then obviously, there are many funds at various stages, including 100X, which will come in and evaluate businesses.
Yeah, right, absolutely. I have one more question. So it is one very important aspect what I feel is for VCs is the exit phase, to decide when to take exit from any startup, any investment that you have. And I had this chat with Bipin Shah as well, who is the co-founder of Titan Capital. So like, what's your opinion on, and what is the typical conversation at your firm to take an exit from any startup, what do you do it after series A, or like do you diversify it, on what factors that does it depend?
So, we've done 142 investments and we've still not taken an exit. It's been 4.5 years, right? And 10 to 15% of our portfolios have gone to Series A and 5% have gone to Series B, right? We are patient capital. We like to stay invested because we want the companies to keep growing, right? And we ensure that they're reaching the next milestone. When to take an exit is a very internal thing, right? And it depends on fund to fund. We are very patient investors, and our objective is to take an exit, possibly Series B beyond. And that's when we'll kind of step in. So most likely we'll start seeing our first set of investments take exits next year when they cross the barrier of Series B.
Can you please quantify it if you can? That would be a great point. Because what is the typical return percentage on a successful investment
I
for
already,
your?
I already, I already mentioned that in the slides, right? The 5 things which we look at: founders pedigree, business model, total addressable opportunity, moat, and our ability to drive a minimum 20x return. A 20x return on the
No,
capital
no.
minimum.
Yeah, okay. All right, sure.
So that's quantifying the amount, right? If I'm investing 1 rupee, I'm expecting bare minimum
Yeah,
20 on my investment.
sure, Shashank. Thank you.
Okay.
So we have another question in the chat. How do VCs recover money if they have multiple failures in their portfolio, particularly from those startups?
So when the VC business is of investing and backing some outliers, so we expect the fatality rate to be 50% sometimes, right? But then there is always going to be that 1 or 2 company which will give you outlier returns, which will cover for the entire fund. So let's say you have 100 rupees, you've invested in 100 companies, 1 rupee each. Let's say 50 fail, and 40 turn out to be only 2x, 3x return. But then balance 10 will end up giving you 20x to 100x kind of return. So that kind of balances out for the entire thing and ends up giving you higher returns for the overall fund as well.
Could you talk about growth hacks? You were talking about growth hacks. So what is it and how does it help? Could you tell more about it?
Well, I mean, see, growth hacks would mean there are many tools, there are many marketing tools. A lot of people end up spending on marketing, right? You don't need to do that. There are multiple tools to showcase your product, push out. There are many Discord channels where you can initially get your set of, beta users. Growth hacks around product development, like as I mentioned, testing it out, right? Today, the way we operate, the way we function, based on the connectivity, I think many growth hacks, whether it's in marketing, whether it's in product launch, product development, in terms of getting remote resources to develop and test out the products, initial testing, coding, all of that can be incorporated, utilized through various other third-party tools without spending too much, right? And that's what I mean by some level of growth hacking, which comes when you are in a product development stage and you're about to launch.
All those who have raised their hands have enabled the mic, so you can ask your doubts.
Hello, am I audible, Shashank?
Yes, you are.
Yeah. So my question is like, as we know that in a VC firm, there are people who are from a generalist background. There are folks who are they are from very highly specialized backgrounds for it, in deep tech or ML or maybe some biotech firm or something, right? So what is
Sure.
the like ideal proportion that a VC firm aims to keep, like in proportion of generalists to specialists, and what is that ratio in your firm?
So we are a sector agnostic fund. So we are all generalists, and we've got one CTO who's also a generalist CTO. He understands tech across all domains because we are a seed investor, and and we don't have that kind of a ratio, because at the end of the day we are a business, and the objective is to get into deals, evaluate them for their tech and for their non-tech aspect, but eventually evaluate a business. And Sanjay, who's an engineer but has built a business, sold a business. Dinad, who's a CA, was the CEO for Aptech and Computer Associates. Um, Third is Yagnesh, who's a CA and was a CFO for Mahesh Tutorials. I'm an engineer and an MBA. Built a startup, sold that in a non-engineering field. And Vatsal, who's a engineer and our principal and CTO, who is a Web3 specialist and a deep technology specialist, right? So it really depends on fund to fund. If it's a deep tech focused fund, you'll find a lot of core team members deeply involved in coming in from specialist tech backgrounds. And the reason for that is because they only do deep technology and they do follow on funding, so they'll be across seed to series A, right? How the product is evolving, is it going to go, whether it's space tech, and the regulations around it, how will that impact their portfolio company? So it really depends on fund to fund. Ours is five of us, four of us are generalists, so to speak, while three of us do understand technology, and we've got one core specialist who's the CTO.
Hello. Yeah, that answers my question. I have a follow-up question. Does this ratio change when
Sure.
we are talking about like later series VC funds or maybe private equity, of the ratio of generalists to specialists?
Again, I think private equity gets in even more generalist because you need more business people, right? So look at any private equity fund. You've heard of Kalyan Jewelers? Kalyan Jewelers was funded by a private equity fund, right? And so were two, three other, you know, uh, tech businesses, right? So private equity funds operate in a very different manner. They essentially are looking for, they'll have a tech team for sure, but more importantly, by the time they're coming in, whatever the technology is, it's built into a business now and growing business, right? So specialists coming with financial background like CFA have more meaningful roles over there, because These are large companies managing their financials and seeing their burn rates and the complexities which come with growing business on the financial side is what a typical private equity fund looks at, right? So if at all tech folks who aspire to join an investment industry, I think they have better chances in the VC domains from seed to Series A.
Okay, great. And what about the funds who are like supporting businesses in later stages, say Series B, C, and like larger growth investors?
Yeah, it really depends on fund to fund, right? There are sector agnostic funds, then there are sector specific funds. Like Speciale is a series pre-series A to series B, a deep tech focused fund. Inflexor VC is a seed to series B fund, right? So really depends.
Thank you, Shashank. It was nice speaking.
Welcome.
Yes, sir. So we have a question in the chat box. A lot of
Sure.
company founders sell their companies and then start a new startups. So is that good? And what do VCs who hold stakes in those companies do in those situations?
Yeah, why not? I mean, if you've built a business, you've scaled, and there is a ready buyer, and there are a lot of acquisitions happen, right? Reliance has bought Haptic, and there's every now and then you're seeing Zomato or some other company buying out. They're buying out because the founders have built tangible businesses. There's value to be created, which was not being created in these larger businesses. And if those founders have the ability to build, make money, and then start again, I think it's a great outcome for the founders, the current investors, and the guys who are acquiring it. So it's a great example. Next question.
Hello, sir. This is I'm audible.
Yes.
So I'm a first year undergraduate at ITBHU. So I don't have any knowledge about this technical terms that you're talking about and all. So would you please suggest me some books so that I can learn from scratch? I'm really interested in this field.
Which field? Building a startup or working as an investment analyst?
Building a startup.
Yeah, I think 0 to 1 is a great book. You guys should read by Peter Thiel. It will give you a
I'm
sense
currently
of.
reading that book.
So great, it's a great start, and I think build on that. I think it's a great book to read on what not to do, what to do. Lean Startup is another book which you should read, and then if you just do a top 10 entrepreneurship books in Google, you'll find so many of these amazing books, right? But I think more than that, I think the ability to just start something, like see, more than reading books and more than understanding the terms, I think the very ability that if you want to start a company, because I asked you that question, you said you want to start, I think is developing a mindset of understanding what is a problem which is existing in your market. If you're staying in North India, if you want plan to come down to South India, what problem are you seeing right now for your generation, right? I'm 42. My generation is different. You guys are going to leap into a very different generation. Your generation is by far the luckiest, I feel, who, who's witnessing the most interconnected time in India, right? Never ever has this time been, right? So tier 2, tier 3, everything is up for grabs, and therefore the opportunity is immense, right? How do you then understand a tier 2, tier 3 buyer, which is huge? That market is huge. What kind of product can you build for them, right? So you're developing that mindset of uh, what can be built which has a large enough market is, I think, the first mindset for an entrepreneur if you're wanting to start. And then obviously with time, when you've identified, you'll automatically learn all these terms: burn rate, product development, product market fit, and all of that, right? That will come to you. You will figure it out. You'll have co-founding team and all of that. But I think identifying what is the next big opportunity is where the fun lies, and developing that mindset is very important.
Yeah, that clears my question. And I have another question.
Sure.
Yeah, so I have some ideas that really need a lot of things like web development and a lot of coding and all. I don't know about them. So what should I do of those ideas? Like, should I drop them completely or should I learn a lot of things which won't be possible.
So, I mean,
Should
I think one thing what you need to do is, you can't start alone. So you need a co-founder with complementary skill sets, right? So what you are good at and what you're not good at. If you're not good at something, let's say developing or tech or coding, but your inherent product which you're building is going to be tech enabled, you need to get a co-founder who's coming from a tech background or a CTO, right? So I think that is very important. But then I've seen many founders, non-tech founders, build some amazing products, right? And I think there are many courses available online to kind of teach you how to do, what to do. We ourselves have invested in a company which is started by ex-Bits Goa folks called Blue Learn. They have multiple courses on multiple topics, right? So there's enough and more material out there to kind of get you kick-started.
Okay, sir. Thank you. That clears everything. Thank you.
Okay, all the best.
Hi, sir.
Next question. Hi.
Hi, sir. Abhishek this side. Abhishek, very good afternoon. I wanted to ask, where should entrepreneurs approach for funding at a pre-revenue stage? Let's say prototype is ready and product is being appreciated by the users. Let's say the
Sure.
target audience. So where should we
Sure.
reach at pre-revenue funding? To whom?
Just apply to 100X.VC. I mean, we've done 62 investments
Yes,
this year,
already done.
and out of which 25% have come, we backed students, right? So 100X is like the ideal kind of a investor you guys should reach out to. And
Like
in
class
case
11.
you don't get, yes, class 11. And in case you don't make the cut, then there are always these incubation center grants which give you 25 lakhs, 30 lakhs, right? Try and get access to those kind of capital.
Can you name some of those?
Yeah, as I mentioned, right, Department of Science and Technology, every IIT has, you guys are part of the ECEL, right? So IIT PHU has an incubation center. I think it's an Atal incubation center, if I'm not mistaken. Then there is, every IIT has an incubation center, either funded by Atal Incubation or by Department of Science and Technology, right? So there are at least, you've got FITT, you've got SIGN. I'm just talking about the IIT ones, right? Then there are Atal Incubation Center, BIMTech, Atal Incubation Center, JSS, there's so many of them, right? Just do Google search on the number of incubation centers, the top ones, you can get access. And each incubation center has a grant Nidhi Prayas scheme, which they have. And that can give you grant up to 1 CR, in fact, and as low as 25 lakhs and as high as 1 CR, right? And that becomes enough capital for the founder to kind of, move to an MVP stage and then apply to, seed funds.
Thanks so much. Like just a follow-on question post that.
Sure.
Which micro VCs to reach at this stage? Like apart from grants, which micro?
As I said, right, share your details to 100X.VC. Happy to kind of look into it and evaluate.
Sure, sir. Looking forward to connect with. Thank you.
Sure. Okay.
Those who have raised their hands can go ahead with asking their doubts. I have enabled
Hello,
on
sir.
the mic.
Hello, sir.
Hey.
Am I audible?
Yes. Yes, you are.
So, Vivek here. My question is that what the founders must be doing to know that the problems they are trying to solve is actually a problem in the market or not? Because most of the founders lacks in realizing this.
Then you lack in getting funding also, my friend. That is what you have to figure out, right? So for instance, you want to build, when we invested in an IIT Delhi kid, which was working on this healthcare company, which I mentioned, right? And, it was a genuine thing. They, either through a family episode, they realized that, blood testing takes a lot of time in tier 2, tier 3 city. And I know this case where Guwahati, where, there was a clinic, and I was just speaking to somebody, and they said, in and around Guwahati, 200 kilometers, people travel for 1 day to give samples and then collect and go back, right? So that's a problem, right? So either you get to know about a problem which you've personally experienced through a family member, whether it could be healthcare, or you are a deep tech coder, developer, and the way you've been working on projects, and you realize some tool is not working, and maybe there's an opportunity to build something. You've done some research globally, and you see there is no other player, but there is only one player. That's how you'll stumble upon, what to do. Again, case in point, there's a company called Solview we invested in, right? It's an ed tech company, and in the truest sense, education technology. What they were doing was they were, and this is just when COVID had hit, they had developed a software which was doing auto grading of tests, math questions, right? Huge potential. And the business model was we'll first begin with kindergarten, right? Kindergarten to primary school stage, right? Easier equations to solve, and then during COVID, a lot of online classes are happening, so they needed a software. Everybody was like, I'll teach this, I'll teach that, but how do you figure out how to evaluate those results once you've conducted all of that, right? So there was an opportunity where these kids built out something which was very tangible, and they had done a research. Who are the other players who were doing this? So to get inspiration, to get an understanding what models work, did not work, right? So there was only one company globally in US which was doing this right at that point of time. So again, when you're starting out, it will require a lot of research. I think today's time, you have enough and more access to content, access to research, access to founders, access to these great forums where you're getting investors to come in, access to their websites and looking at their portfolio companies, access to those founders through LinkedIn, Instagram, whatever, right? The ecosystem has become a lot more porous. You can have these organic conversations a lot more than maybe when we were kids we could have, right? So you develop your own process and you figure out what is the next big thing which you guys want to work on, right? That's my input.
Okay, thank you, sir.
Hi, Shashank.
Hi.
Yeah, I wanted to ask. We are a startup in a tech-enabled startup, and I have technical co-founder. I have data server. We are bootstrapped company. We have audience and the requirements necessary. I wanted to know how should a tech startup recognize its valuation, calculate its valuation.
So you're just starting out. I don't think so you need to focus on valuation. What you need to work towards
Yes.
is finding a product market fit and stickiness, right? I just gave you our entire fund is based on not valuing the company beforehand, right? We are giving
Hmm.
investments for a future equity, right? So at this stage, founders get bogged down ki bhai valuation kitna rakhna, and I think that's the wrong mindset. I think what you guys need to be focused on building the product and it working and it achieving that stickiness, because there are many institutions like ourselves who are willing to fund for a future equity, right? We're giving the money right now and it gets converted into equity at the next valuation round when you've grown a certain metric. Ki bhai mahine, every month on month you're growing on a certain metric, right? So don't bog yourself with the valuation. It will come if the product is working, if the product is creating enough stickiness. So focus for you should be on getting the utility of the product established.
Yes, this question came in my mind because last time one VC asked me this question, that what's the valuation or how much have you invested in this company? But because we have been a bootstrap company and I'm putting my time in marketing and my other co-founder in technology part, that's why we didn't have the answer to this question. So I asked this.
Yeah, so I mean, I'm
Thank
I'm a
you.
different kind of an investor because we don't value company. मेरे को आता ही नहीं valuation करना. I only know how to invest in companies and then help them achieve a valuation, right? And that is a function of the product working. I'm coming in at that stage, right? So
Right.
at late stage, VC will ask you that. How much is your revenue? What is your valuation? But we don't come in at that stage.
Getting it. At what stage should a company feel that they must apply in a VC firm to get investment and
Yeah,
they are ready for it?
once you've developed a not an idea stage, get bare minimum stage should be minimal viable product to early traction. If you're getting early traction, very well, that's a very big positive. But if not, at least the product should be working. So if you're able to show a tangible product, then that's a good time to apply to seed funds like us.
All right, got it. Thank you.
Okay.
Abhishek, you have raised your hand. You can go ahead asking your doubt.
Any more
Anybody
questions,
else?
guys?
Kindly raise your hand. We won't be taking doubts from the chat box. Please raise your hand.
Hi, am I
I
audible?
wanted to ask one more question. Shashank, am I audible?
Yes.
Um,
Yes.
we are not a registered company, so VCs do VCs invest in do help in registering the company and investing in.
Yeah. So I mean, we've invested in when we got interested in decided to invest in companies. Many of our companies were not registered. So after issuing a term sheet, we then figure out with our team, ensure them how they are supposed to connect them to a particular CA, and, figure out your registration and all of that. Because a VC can only invest in a registered company. So we are a SEBI registered fund, and we can only invest in private limited companies. You can't invest in NLPs, right? So, but that's not, see, in your mind, don't have that block. वो सब हो जाता है as long as the market you're building for, the product you're building for is good, all those ancillary things, valuation, registration, सब हो जाएगा.
All right. Thank you, Shashank. Thanks for that.
Sure.
Hi, sir. So
Hi.
question was, how much time does it takes once a VC shortlists the startup to invest in to the time the money comes into bank account? What is the process in between the due diligence and how much time does it take?
Yeah, I mean, I can't really comment on other thing, but other funds usually take 60 to 90 to maybe 6 months also because it's a valuation round. And the reason why we are doing ISAF is because of the speed, because the money is required to build out the product, to test the market, right? So we invest typically if we've issued a term sheet. From there on, within 10 days, we finish the due diligence, and within 30 to 35 days, the money hits the account for 100X.
And what are the things that you look into due diligence?
Financial due diligence, are there any loans, is the product working, technical due diligence, founders' backgrounds, all of that. Standard DD process which happens for a VC. Tech, financial, founders' background, company structure, if it is already existing limited company, founders not being full-time, founders not running another companies, so on and so forth.
Thanks, sir.
Prerna, you can unmute yourself since you have raised your hand.
So I wanted to ask how to protect the ideas while pitching them. Like some of the ideas, they are not very hard to implement. So we always have the fear that if we tell the idea publicly, it might get copied very easily.
Yeah, so ideas, is ideas are dime a dozen, right? So it all boils down to execution, right? So founders who are scared of sharing the idea will not be able to build the business, right? So you need to learn to execute, right? Kerala banana chips का मैंने आपको example दिया, तो कोई भी बना सकता है ना. तो जब उसने आइडिया बना के पिच करा होगा तो उसको लग रहा होगा तो मतलब कोई भी बना सकता है. को बना रहे हैं लोग, right? He still got funded. He raised 3.5 mil right now. He's doing 2 crores per month, right? So the mindset has to be that अरे मैं इसको बताऊंगा तो ये कॉपी कर लेगा. It's not the thing, because idea keeps evolving, right? तुम you think of an idea, you put it into a skeleton, you bring it a shape, that vision will remodel itself into something else. What ends up working will be different. Your association of the beta product will have an association with the customer, so loyalty will start coming in, and then execution. So the question is, how quickly can you reach these stages, right? Your ability to try, fail, come back, try, fail, come back, and try, keep moving, right? And building that flywheel, I think is the most important mindset you have to develop. But sharing an idea, I mean, if and it should get copied if you are not able to execute, right? People will copy it. So that's my challenge is not by sharing the idea. My challenge is not implementing your idea quick enough is a bigger problem.
Guys, due to paucity of time, it's a request that please stick to only one question per person so that others also get a chance. Saksham, you can go ahead. You were raising a hand for a long time now. Saksham, are you there? Hemant, you can go ahead if Saksham's not there. Next, Chetan, if you're there, you can go ahead.
Hi, sir. Good afternoon. So, what is the difference between deep neck and bottleneck?
Sorry, I didn't understand the question.
What is the difference between deep neck and bottleneck?
What is the difference between deep tech?
Sir, he meant deep neck and bottleneck.
Deep neck and bottleneck.
Yes.
Strategies.
I wouldn't know. Why would I don't know. Bottleneck is a bottleneck. What's the context? I didn't understand the question.
Sir, in previous phrase you have used sir, like what deep tech.
I can't hear the question.
Sir, previous while you are saving, you use the word deep neck. And
I said deep tech.
Okay, deep tech. So in presentation, see the word like bottleneck. So what is the difference between this and that?
Deep tech is a type of technology. Bottleneck is something which you create by having a lot of inaction. Deep tech is a sector. Bottleneck is something like bottleneck create ho jata na. That's the difference, right?
Thank you, sir.
Thank you, Chetan. Prerna, you can go ahead. Rav, yeah.
Yeah, so I wanted to ask that I recently read about Radical Ventures, which is world's largest venture fund. It released an open source resource named RAIS framework that can help VCs to evaluate startups. So, what is your opinion about it? I wanted to know: do you think such technological involvement or software involvement is would help VCs to evaluate startups, or it has certain disadvantages?
No, I think this is an evolving space, and there's definitely a lot of advantage. VCs with time, with technologies getting more complicated, and the utility of each technology developing on a day-to-day basis. I think these kind of initiatives will only help us evaluate further, right? With every day you're seeing a new version of chat gpt and its ability to kind of fundamentally uh, do some groundbreaking work in terms of generative ai, right? And sometimes you might not be at the pace of evaluating that, and hence I think such initiatives will help the vc. The future of vc cannot only be humans evaluating. It will be a mesh of technical softwares blended with human experience coming in, and all of that amalgamated together.
Okay, thank you so much, Shashank.
Ravinder, you can go in next.
So we are often heard saying that when we don't know a particular set of skills, we hire people. But from an early stage of point of view on a startup, we as a co-founder lack certain resources to do so. So when is the right time, and when is the right thing to hire people? Like I don't see many resources around me to hire people. So could you
To answer that question, I think by the time we come in, we are essentially backing only the team. We've invested always in companies जहाँ पे सिर्फ 2 ही founders या 3 founders काम कर रहे हैं. Maybe एक intern या 3 interns होंगे, right? And so you need to develop this mindset that at least for your first 4 crores of fundraising, can you and the co-founding team do everything? Because that is what building a startup is all about. I'll give you a story and a live example, like an example, true story. I worked in various organizations, larger, and then did my MBA, and then became the founding member for a startup. And we were building a SaaS product. I moved to Bombay. We built and launched the product. I used to work from my home, and I was the only person, right? And then I had a private equity client. I went to them and I said, I'm planning to hire now. It's been almost a year and a half, and I've got some budget and product is working. We've got 100 clients. And he said, please use my office space. You can work out of here. So I used that office to hire people after 1.5 years of my product launch, with my co-founder sitting in Delhi and me working in Bombay, right? And then after hiring the first set of two people, I had a unique problem. Both of them were girls. I had three people, so two girls, one boy, and myself. So essentially, two boys and two girls. So we said कि अब अपने office में shift करते हैं, and I moved to a new place, and I found a very cheap office. And there, the challenge was, it was in an old, nice place in Bandra in Bombay, facing the lake and all that. But these were old buildings जिनके अंदर common toilets होते हैं, right? Now, obviously, I had two women in my team. I couldn't let go of the place. तो अब मैं क्या करूँ? तो मैंने पूछा tenant से कि यार, sorry, I was tenant, the owner, कि are you okay with building an toilet inside? He said, yes, we can build it. You guys can figure out what needs to be done. So it took me 45 days to build that toilet, right? And if any one of you would have met me that time, you would have asked me कि सर आपका प्रोडक्ट का प्राइसिंग क्या है? मुझे इतना पल्स नहीं था, पर अगर आप पूछते कि मार्केट में सबसे सस्ते स्विचेस कहाँ मिल रहे हैं, कमोड कहाँ मिल रहे हैं, I would have told you that, because I spent 45 days building a bathroom ground up, right? So point I'm trying to make over here is that when you are in the founder's seat, I think hiring is important, but you need to come with a mindset of preparedness that कुछ साल तक you are everything. You're the toilet cleaner, you're the toilet builder, you're the salesman, you're the operations person, you're the finance person, you're the product guy, right? You learn a lot of things, right? And that mindset, I think, is very important, very, very important. You talk to any seasoned entrepreneur, and everybody would have gone to that stage where they were doing something they've never done in their life: cleaning toilets, building toilets, closing the shutter, opening the shutter, cleaning the kitchen. So before you hire, keep a milestone that can you build with your own co-founding team? Can you do sales? Can you build the product? Can you go out to the market? Can you reach to clients by yourself, working 12, 13, 15 hours, right? Till the time you raise your first 3 or 5 crores, right? You find the answers there, right? So hiring comes in much, much later. And when you're ready to do that, getting talent in India is not a challenge anymore. Unlike your generation, our generation had a huge challenge when we said कि भाई हमको startup start करना है, hire करना है. Everybody like, are you mad? मैं IIT जा रहा हूँ या मैं MBA करने जा रहा हूँ, IIM से मैं क्यों startup join करूँगा boss? I want to earn, yeah, I want to get a 50 lakh package. The mindset has changed now. People understand that I want to work for equity. I want to work for 6-8 months in a company, startup as an intern, right? Hiring is not a challenge anymore. But before hiring comes the mindset that how long can you push yourself to ensure you remain frugal and achieve product market fit before you start hiring extensively.
Thank you, so very good insights on that.
Yeah. Saksham, Dipankar, are you guys there? Else we are good to wrap up. Okay, Ananya. I
Hello.
guess Dipankar is here. Yeah, Dipankar. Go ahead.
Am I audible?
Yes.
Yeah, sir. I just wanted to ask, like, what is the threshold in terms of experience and technical qualifications to start a venture fund in coming future?
Start a venture fund. I think starting a venture fund also requires the same mindset as starting a company. You need to have complementary skill sets in your founding team. So when it came to 100X, I've got Sanjay, who's already invested in 100 companies in his personal capacity, angel investor. I had done 5. We had a fund, and between me and Sanjay, we were good at speaking with founders and evaluating businesses. And Ninad was, great at, ensuring once you've invested, you're able to take the company to the next level in terms of business. And Vatsal, great at, look at like, this is a product and this is the technology they're using, this much they can build or this much they can build, right? And that's the complementary skill set, right? So very much like building a startup. And I think what helps is experience in building a fund, because if you have like 10-15 years of experience in having worked in the ecosystem, it really helps. And if you are a founder, like me and Sanjay had been, then operator experience really brings a lot of insights, because you've been a founder, and when you're evaluating business as founders, as ex-founders, you're able to see through a different lens, which you might not be able to if you've never been a founder, and just look at businesses from a financial domain. There's an emotional aspect to it. There are pivots to a business. How does a founder respond to that? It's lot of psychology also comes into the picture, right? When the shit hits the roof, things don't happen your way. What is this guy going to do? So there are a set of questions, a set of experiences you go back to, and then try and visualize, is this founder going to do that, or how is he going to behave, right? So experience definitely makes a lot of difference when you're starting a venture capital fund, and you're just having a great team, right? Who can help you identify the right set of founders, source deals, your network of, once you've invested, can you take these guys to businesses where they can test out their products, because everybody needs to build faith in new products, right? So as an investor, are you only providing capital, or can you actually open doors for them, because that is the most important thing. So all of these things make a difference, and I think these are requirements and most essential key elements to have when you're starting a fund.
Thank you, sir, for answering so many doubts. So, guys, this concludes today's session on understanding the venture capital ecosystem. On behalf of the entire ESAIL team, I would like to express my gratitude to Shashank sir for taking time out of his busy schedule to join us today. Your passion has been most inspiring, sir, and your insights have definitely enlightened us. Thank you to all the attendees who were present for today's session. You will be provided additional Notion resources for the upcoming sessions and the related assignments on the WhatsApp group. Please don't hesitate to contact the organizers in case of queries. Thank you.
Thank you, guys. All the very best, and feel free to reach out to me. And if you're building something, feel free to apply to 100X.VC. All the very best. Thank you. Thank you, Ananya. Thank you so much.
Thank you, sir.
Thank you, sir. Thank you.